Hey, what's up, everyone? Unless you've been living under a rock, you've probably heard the term private equity or PE. Whenever careers in finance are discussed, private equity is inevitably spoken about as if it is a glorious promised land of vast riches and wealth. And the argument could be made that that is relatively accurate. PE firms have been known to rake in millions of dollars, not just for their investors, but also for themselves. After all, Stephen Schwartzman, the CEO of Blackstone, was the highest paid executive in the world last year. He brought in total annual compensation of more than $1.25 billion. That's 10 figures. And that's probably why everyone is trying to get into the industry, whether it's burnt out investment banking analysts or social media influencers. But even amidst the allure, I have recently noticed in the news and media that private equity is generally misunderstood. The industry is often painted as an evil villain wreaking havoc on middle America, which is an argument that may have some merit, although I do happen to think that PE still does more good than bad. But that's beyond the scope of this video. Instead, today I plan to discuss the foundations of private equity and what you need to know about the industry. This is by no means a comprehensive breakdown. I'm going to leave that to the pros, but I do think that you will leave this video a much more informed student, professional, or grandma. Hi, Nana. If this is your first time watching one of my videos, then hey, my name is Cameron Galbraith, and I am a finance professional here in New York City. This video is part of my new series, Wall Street Simplified, where I break down opaque finance topics into easy to understand videos. If you're not already, make sure to subscribe to my channel so you don't miss an upload. Today's video will be broken up into 4 topics. First, what is private equity? Then, how the private equity firms create value, followed by the different private equity investment strategies, and finally, how private equity firms exit a deal. So, with that said, let's get into it. So, as the name suggests, private equity is the ownership or interest in an entity that is not publicly listed or traded. So, unlike Apple, which is listed on the NASDAQ and anyone can buy a share of, private equity deals strictly with companies that are privately owned and typically not available to the average person. Private equity is actually the term for the source of investment capital. Private equity investments come from firms that purchase stakes in private companies or alternatively acquire control of public companies with the intention of taking them private and ultimately delisting them from stock exchanges, aka a go private. Like any investment, private equity is used to buy companies with the hope that the company's value will increase over time. But unlike a hedge fund or an asset management firm, private equity firms often play a much more active role in increasing their portfolio company's value. Similar to hedge funds, a private equity firm's partners raise funds from investors like wealthy individuals and institutional investors with the goal of generating a positive return not available elsewhere. The time horizon of these funds and investments is typically between 4 to 7 years. That is the standard time that private equity firms feel they need in order to find and turn a business around, which leads us into how the private equity firms create this value. So private equity firms perform 2 critical functions which work in phases. This includes deal origination and transaction execution, which leads into portfolio oversight and management. According to Investopedia, deal origination and execution involves creating, maintaining, and developing relationships with M&A intermediaries, investment banks, and similar transaction professionals. These relationships secure both high quality and high quantity deal flow and often is how firms are referred to prospective acquisition candidates. Because the nature of PE is finding diamonds in the rough and boosting their value, firms spend a lot of time searching for acquisition targets. But unlike the public markets, once a target is identified, the firm still has to actually convince the current owners to sell, which is often easier said than done. During the search process, firms leverage a lot of metrics and tools like the current executive team, the industry, revenue forecasts, and of course, plenty of valuation models. But once the due diligence is complete and a company is acquired by a PE firm, the second function can begin. Portfolio oversight management is the process of strengthening the business. This is done in numerous ways, but can most succinctly be phrased as increasing operational efficiencies. It's this aspect of private equity that sometimes gives it an ominous reputation. Firms are known to slash costs and cut any fat that they can find. This typically means reducing overhead by laying off employees that aren't providing sufficient value to the company. Alternatively, firms occasionally raise prices to boost revenue and partake in other revenue-generating activities that maybe the old company didn't do. A good example of this is JAB Holdings, which is a European investment firm. They famously created successful subscriptions for two of their portfolio companies, Pret A Manger and Panera. This has boosted profits for both firms and is something I discuss at length in another video on my channel. But sometimes a company doesn't need an entire overhaul. Oftentimes, a change in IT, accounting, or even just branding can boost the value of a company. What is important to know is that private equity investors aim to find ways for the businesses to improve EBITDA, or earnings before interest, tax, depreciation, and amortization. This, above anything else, is the golden metric. Now that we know the goals of private equity, let's discuss how they're able to execute it financially. The most common way that private equity firms are able to purchase a business is through a leveraged buyout, or LBO. If you're currently recruiting for investment banking or private equity, you better know what this is. But if not, LBOs are exactly what they sound like. The purchase of a company is financed through debt, which is collateralized by the company's operations and assets. As the leveraged in LBO suggests, private equity firms are able to assume control of a company while only putting up a fraction of the purchase price in cash up front. Then the debt is paid off by the cash flows of the business, which, if a private equity firm does what it's supposed to do, should more than cover this expense. Now, this should allow you to see how private equity can become very profitable when done correctly, especially in a time of low interest rates. Because a private equity firm is able to use leverage to buy a company, they're only spending a fraction of the purchase price for a business. Then, if a firm can successfully optimize efficiencies and increase profit margins, they can rake in millions off the differential between the interest costs and the cash flow of the improved business. This together is then what makes a private equity portfolio company ripe for an exit. Another investment strategy that technically falls under the bucket of private equity is venture capital. VC is used to take an equity investment in a young company. These companies are often in a less mature industry. Think internet companies in the early to mid 90s or AI right now. I'll be making a separate intro video about venture capital in the coming weeks. So again, make sure to subscribe so you don't miss that. Okay, so now that a private equity firm has bought a company and worked to make it more successful, it's time to talk about how it exits the investment. A typical exit for a middle market company is to be sold to a large corporation in their vertical or oftentimes an adjacent industry. This purchase price paid by the large company should have a substantially higher valuation than what the private equity firm bought the company at, allowing them to sell all of their equity in the business and cash out. Alternatively, though, some investors might ride their portfolio companies all the way to an IPO, allowing investors to ultimately sell their shares in the public market. So to wrap this all up, private equity firms invest in private companies that have potential for growth or opportunities to boost earnings. The investors then strategically look for ways to increase the value of the company. And once this is done, the private equity firm sells the company for a profit and will use the capital to do it all over again. Dan Toomey from The Morning Brew put it quite simply when he compared private equity firms to house flippers, but instead of houses, it's companies. And with that said, I hope you guys enjoyed this video. And if you want to see more content just like this, make sure to like and subscribe. I plan on doing many more deep dives into different areas of finance in the future. So if you have any topics you want to see, make sure to comment them down below. And as always, if you have any questions at all, reach out to me on Instagram at Galbraith or connect with me on LinkedIn. I hope you enjoyed this video and I'll see you in the next one. Peace.